AT&T, they just reported. Now, they showed some growth, but you got to remember that their growth came when it comes to taking out, when they spun off their video division. So the revenue looks like it's gone lower from same quarter to same quarter, but they took off the video division. So taking out the video division numbers from last year, they had a 3 or 4% jump in revenue. They beat on revenue and earnings. Earnings per share of 68 cents versus estimated 61 cents. Revenue of 30 billion versus what was the exact number? The exact number was 29. The estimate was 29.8.
Yep.
Okay, so guys, AT&T did great. They still have a debt issue. There's still questions right now about their debt. Because they reported lower free cash flow, right?
Yes.
So they reported a concern of lower free cash flow. Now remember, guys, we talk about this on the channel all the time. Free cash flow can be used to do 5 things: buy back shares, pay a dividend, pay down debt, invest in yourself, and make acquisitions, okay? So when you're paying down debt, you need that free cash flow to stay up there.
Yeah.
So even though revenue and profit were up, free cash flow is down, and it issued some concerns.
Yeah, especially with that. I mean, their dividend is huge. They've been known for the huge dividend.
Yeah,
They're
the
not
dividend
known for paying down debt. So
yeah, their debt is big.
This has always been the concern of mine, is the debt.
Yeah, and we've always had a concern about that.
Yep.
So the forward dividend is like a little over 7% on AT&T, and that's exciting. And people love the idea of a dividend, but remember, you need to make sure they can afford the dividend, because if there's any issues with debt, you better believe the first thing to do is cut that dividend.
Yeah,
because
absolutely.
The covenants on the debt, I don't know what the exact covenants are, but you can find it in the 10K. But it's super important that with the covenants on the debt, that they're able to manage it all and not put themselves in a position where people are calling it debt. Especially, I want everybody to remember, when banks' backs are against the wall, they don't care who you are.
Nope.
And if they need to call that, they will call it.
Absolutely.
This was especially apparent during the Great Recession in 2007, 2006. I had friends who'd made every debt payment they could. You might sit there and say, well, Paul, it's different for individuals versus companies. Guys, if you're telling me that a bank's willing to walk into an office of an individual and say your loan is due and it might cause you financial ruin, we're okay with that, they will definitely do that to a major corporation.
100%.
Right? So, yeah. Mo, can you talk about some of the numbers they reported on their mobile and their fiber?
So looking at, I mean, they came in with 708,000 postpaid wireless. That means cell phone plans. So that growth was incredible. The estimations were 552,000.
Yeah,
so they crushed there.
Yeah.
Fiber came in at 338,000, topping the expectations of 330,000. So this fiber thing is certainly growing, especially in those rural areas of the country.
Rural. I like the AT&T fiber. At my previous house, I got AT&T fiber. It was fast as F.
Yeah.
You don't have AT&T.
I live in a communist area where I have no choices.
My new house upcoming, I don't have the option for AT&T fiber, and that kind of bothered me. But right now, I mean, look at the stock right here, guys. The 1 year, I mean, this is a up and down stock. Look at the 5 year. The 5 year is terrible. I mean, they have a high here in the 5 year chart of around $30. I mean, it fell almost 50%.
I mean, if you look at their chart going max, I mean, we're at 1994 numbers of the stock price.
Yeah. So look at enterprise value here, Mo. So we've added some data to our software. Market cap is 120. Enterprise value is 406. That factors in all the debt. So if you were to buy the company AT&T in full and wanted zero debt, that is a $407 billion enterprise.
Thanks.
As an example, let's pull up a company like Google. Google's market cap is 1.3 trillion and their enterprise value is 1.4. So that's the difference. I mean, the enterprise value in Google is a few percentage points more than its market cap, right. But while AT&T is several times more, that shows the debt level. And this is something we added because we wanted people to be able to quickly look at a company and say, whoa, that's a lot of debt.
This is a lot. I mean, I think if you look at T-Mobile, Verizon, you're going to see similar enterprise values compared to market cap too.
Okay, so let's look at that. Let's look at Verizon. Market cap 156, enterprise value 437.
There you go.
Highly debt-laden businesses. And, you know, guys, debt works the same way for a company as for an individual. The more debt, the more issues. Now, these companies are fabrics of America. Got it? So I get that. They can support higher debt levels. But you need to research the debt and what the average rates are. Rates have skyrocketed last year. That may not mean anything for the companies today. But when they go refinance these big debt levels, so let's say hypothetically, and I'm not trying to play an alarmist point of view here, but looking at AT&T, their long-term debt right now is $242 billion. So call it $250 billion. So at $250 billion, let's say their average refinance is 3% higher than it is today. What's 3% of 250? $7.5 billion. $7.5 billion, and your free cash flow last year was $14 billion. That eats up half of your free cash flow by keeping the company exactly the same capital structure that it is today. Now, does that mean they're going to go under? No, it just means that, listen, it's something to consider when looking at your downside risk. Mm-hmm. You have to go understand where their debts are and when they expire, right? What levels of expiration are these debt levels? Is it something that's going to be intermittent as time goes on? It's something that's big full? I don't know. And that's something we'll find in the 10K. Yep. So let's look at this from an analyst estimates here. So here's the earnings per share by analysts. They start at 29 analysts, and as time goes on, it drops to 15. Guys, look, 261 this year, 259 in 4 years. That is it's downward movement.
Yeah.
It's basically the same.
It's stagnant.
Look at revenue. Expected to do 130 this year, expected to do 121 in 4 or 5 years. Does that mean you shouldn't buy the company? No, because remember, declining revenue, declining cash flow still has some sort of value. For me to explain that, let me show you an example. So let's say a company here, let's say you have a company with zero debt, and I'm going to go very simple. And you know that the next 5 years, they're going to make $5, $4, $3, $2, and $1. Wouldn't you pay something for this? This is $15 in cash flow. Even though it's declining and going to zero, there's still some value. Now, the debt on AT&T adds a little bit of a sidewinder there. But for me, I personally avoid AT&T because of that. Yes, the dividend's attractive, but that debt covenant, the debt on that level of that company is just so much.
So you said the dividend's attractive. Their free cash flow last year was $14.3 billion. They paid out $13.3 billion.
Yeah, last year.
5-year free cash flow, $23.5 billion.
Yeah, but I look at this like, what's the 7% dividend yield right now would pay out about $8 billion, right? And they're expected to they did $3.8 billion last quarter, multiplied by 4, that's $15 billion in free cash flow. So it's still a big chunk. But for a company like AT&T, they have to pay a big, where are their growth opportunities?
Yeah, they don't. They have to attract.
And they're not reinvesting the money at high rates of return. What's their return on invested capital right now?
Let's see, 3.3%.
Yeah, 5.4 on the 5-year and 3.3 on the 1 year. Like, not for me personally, and I'm not trying to, it's very rare that I see such a cheap company relatively. Look at the PE here. We have a 1-year PE of 6, a 5-year PE of 7.5, and I'm sitting there saying, like, it's just ugly to me. Let's go to the funny part is, let's go to Stock Analyzer tool.
Look at the 8 pillars. It's actually the opposite of what we want.
Yeah. Oh my God, you're right.
Yeah.
So the 8 pillars we love when it's all green here and red here, because all that means we have to wait for the stock price to fall. But the fundamentals look pretty good. There's nothing here that I'm just like, yippee. Let's go to the Stock Analyzer tool, Mo. All right. I'm going to do -2, 0, -3.
That's better. Yeah.
-1 and 1%. Profit margin. I'm going to do 7.5, 8.5, 9.5. Free cash flow margin. I'm going to do the exact same thing. Now, again, they had higher numbers here, but they also spun off a division, etc. PE, I'm going to go 7, 9, 11. 7, 9, 11. And because of the debt, I want a higher rate of return. I want 13, 15, and 17. I'm really butchering this thing.
I think that those are pretty fair numbers.
And I think it's going to come out all green.
I think it probably will.
No, it did not. All
All
right. We have a low of 9, a high of 13, a middle of 11. Guys, this is the kind of stuff we do on this channel. You can't miss these videos. We do 20 plus videos a week. During earnings season, we do 4 or 5 videos a day because we are immediately responding. Last night, Tesla reported at 4:15. By 4:40, we had a video posted where we evaluated the company, we looked at it, and we saw it from there. So you must subscribe to this channel or you're going to miss out on a lot of immediate reaction to videos. Don't you think, Mo?
Yeah. So even if you say profit margin of 9.5%, I put in a 3% revenue growth, which no analyst is even in the positives.
Yeah.
You're still not there.
Yeah. For me, with the value and the debt level, I just want to stay clear of AT&T. So guys, please make sure you subscribe to this channel. We have tons of videos Mo and I do. You're not going to miss out. Subscribe above. Thanks very much.